Okay, here we are in week 10 with chapter 9. This week we'll also have an exam, exam 2. Exam 2 will not cover this week's material, so you'll have two things to focus on for this week. In a way, this week is somewhat similar to last week in that we're going to look at bonds a little bit more. The only difference is we're going to look at bonds from the other point of view. We're going to look at as we are the ones issuing the bonds and how that would be different. Calculating the bond sale price would be the same, but how you record it is a little different. But before we do that, that'll be our last item. We're going to look at three different things today: warranties, interest on notes, and then the bonds. So the first thing is looking at how companies record a warranty. So if you buy something of a high dollar value, either there may be a warranty thrown in, a general manufacturer type warranty where it covers 3 months, 6 months, and if something happens, you get a free replacement. You could also pay for a warranty as well as an additional payment, but that's not necessarily what we're going to be looking at here today. We're going to be looking at just a warranty that comes with a product as is, no extra payment needed. So this is going to be similar to bad debt expense, which we looked at a few weeks back in the receivables, and where we had to estimate how much we figured was not coming in as payments. So if we showed, say, $20,000 in account receivables, how much of that $20,000 do we think we'll really get? We don't know who won't pay us, but we know probably somebody won't. So we need to estimate up front. And that's what we're going to do here with the warranties. We're going to estimate up front and create a warranty expense with our estimate based on how much of sales for that product we made. So again, in accrual accounting, we need to estimate items that may soon happen, like the bad debt did, because we're going to match. Basically, why we do that, we want to estimate. I don't want to put these expenses on the books next year when they may actually come up, because I want to match. If I sold the item in October of 2015, I want to match that to the expense with October 2015 and not put it in 2016. If that makes sense for that type of transaction, and this one we can easily do that. And then what we're going to do is we're going to create that expense, and then we're going to credit this. I should put in here estimated warranties payable, because we don't actually owe anybody anything yet, but it's there. It's money set aside. You know, conceptually it's set aside. It's really not in any special account, but we've already expensed it. So all we have to do now, if somebody does come at us with a claim, is we just take the money out of this payable account and we don't expense it again. And that's what I say here in this third bullet point. The last thing is to determine, well, how much of a warranty expense do I expect to come in on a yearly basis? And you're going to base that off the sales of that item. So you'll look at past records for that type of item, or you look at your past owned business records and say, well, about 5% will have a warranty claim. And so I want to estimate that. I want to say 5% and then make that calculation in that journal entry. So let's look at this opening exercise here. We have an opening balance of our estimated warranty payable of $1,100. So that's still money I have expensed in the prior year that people still haven't came to claim yet, but I expect them to. Doesn't mean they will, but I expect to. This year's revenues were $50,000 for this product or whatever it is, and we estimate that 12% of the value of those products will come back as a warranty, and we'll need to provide them. And so if we're providing them with a free product, that's why it's an expense on us, because we're not getting anything, but yet we're losing some of the product that we bought. And then the final thing I tell you is during the year we actually had $6,800 in warranty expenses, or not expenses, that's the wrong word, in warranty payments sent out. So this is our adjusting entry. This would be to show, all right, if we made $50,000 in sales, how much did we need to record as a warranty expense? So all I did is take 50,000 times 12%, and you get $6,000. So I need to add $6,000 to this year's warranty expense, and then add that to the beginning balance of my wages or my warranty payable. So now my warranty payable is up to $7,100. Then if I pay out $6,800 in warranty payments, notice I don't expense it again. I simply take it out of this payable account that I thought I would owe, and I owed most of it. So the balance is $7,100. I'm paying out $6,800 in cash, or I'm either giving them a refund or a product, and I'll just make it easier and say I'm giving them a refund. So my ending warranty balance at the end of this year would be all the way down to $300. And that's okay, but it's getting kind of low. We don't want it to be a negative. So in the future years, I may have to revise this 12% a little higher if more expenses are coming. Okay, so there's one problem about warranties on your exercises. There's a problem about notes and interest, and interest goes right into the bonds, which is the main part of this chapter that at least is covered in the homework. So that's what we're going to spend the rest of our time dealing with interest type issues. The main thing to know is, what is the interest formula? And hopefully you've heard of PRT in some math class or any other class that may be in business class. Principal times your rate. Principal is what you owe on your note. Rate is the interest rate, and then time is always listed in years. So if your rate is 8%, that's 8% for one full year. If it's 8% twice a year, that's 4% every single time. 4% in, say, July, and then 4% in December. But so we always do the rate in a yearly format. So if it was, say, 8%, we would do 8 here, but time would only be half. That half would be 4%. Or if it was monthly, it would be, time would be 1 over 12. 1 month out of 12 in a year. Another thing we have to do in accrual accounting is accrue our interest at the end of every reporting period. So if we have a reporting period at the end of the year, even though there isn't any interest due yet, I don't have to pay anything at the end of the year, I still have to show that I owe it. And that's one of the things we're going to do in our example. Some notes are paid all at once. So you take out a loan, and then at a set time in the not too distant future, you're going to pay it all off, including interest. And then probably more realistic, in most of your loans, you're going to pay them off over time. You're going to pay them off in a monthly payment. So with those monthly payment type loans, you're going to find that your principal, what you owe, continually goes down little by little. Therefore, if your principal goes down, that's going to affect your total interest, and it's going to make it go down too. That's why if people ever say pay more, pay as much as you can on a balance of a loan, that's wise to try to get that interest lower and lower. So the less interest you have to pay, obviously, the better. Our first example here is going to be looking at a lump sum return payments. So we're not making any payments until the very end, and I pay everything off, including the interest. So I took out an 18-month loan for $10,000 in July, and loan is to be paid off. So in 18 months, that would be next December of the year 2. Our interest rate is at 8% and normal year end. And that normal year end means I need to do an adjusting entry to show how much interest is accrued for the first 6 months. Okay, so my opening entry, the day 1, I got money, and I'm going to show that I owe money worth $10,000. At that day, that's how much I owe. Come down to 12/31, I now owe some interest. Even though I don't pay it, I still technically owe it at that reporting date. So I need to calculate how much. So I take the principal, I still owe $10,000, I haven't made any payments, times 8%, and this is for a half a year that it's expired, from 7/1 to December 31. So when you calculate that out, you get $400. So my interest expense for the year is $400, and I need to show that on my balance sheet as a liability that I also owe $400 because I have not made the payment. Now, when it comes to 12/31 next year, the end of next year when the loan comes due, I'm going to pay off that loan. So that's the $10,000 being reversed from up here. I'm going to pay off the interest from last year, the $400, and I'm going to pay off the interest this year, $800. And then how I got that $800 here, the principal, I haven't paid anything on my loan as of till today, at 8% times 1 full year actually expired. So that's the $800. Total that I pay back, credit my cash for the $11,200. Now the difference between the one up here and this example, they're almost identical. I use the same type of numbers, except this one we're going to have repayments. And the company is going to give us, again, 18 months to pay it off. But we don't have to make our first payment until 3 months down the road, till the end of September. So they're giving us a little bit of time to use our money, then we start paying it back at a clip of $700 per month. All right. Actually, I'm gonna revise this and say we start paying it back July 1, because I don't want to have any interest accruing. That's going to be too confusing. We'll start paying it back July 31st. Take these out. Oh well, formatting, you can deal with that. So on 7/1, we had $10,000 of our loan. Let me change these dates real quick. This will be 8/31. Okay, so on 7/1, we took out our loan, so obviously we don't have a cash payment yet. No interest is accrued as of day one. $10,000 book value. And here's my journal entry to show that. Now I come to the first payment that's due, and how I can kind of walk you through how I got some of these numbers. The $700, that's obviously given to us. And then our interest expense, all I did is take $10,000. So let me show. I'll type this out so you can see it. My interest equaled 10,000 times 0.08 times, and then I'm dealing with monthly payments, so 1/12. And if you're doing this on your calculator and you don't have a fraction button, I would do 1/12 first. Do 1 divided by 12, and then just work backwards, times 0.08 times 10,000. And that's how you'll get the $66.67. And then this number here, that's the amount that goes to the interest. The rest goes to the reduction of the note. So my note balance, if I'm looking at a T account and I had 10,000 in that T account, and then I just subtracted 633 that was off of that note, I'm now down to just 93.66 due at the end of the first month. And I'm going to calculate this next interest on my new principal. So here, my interest equals, instead of 10,000, it's now 93.6667 times 0.08 times, again, just 1 month. How much interest is it going to expire between July 31 and August 31? And it's going to be $62.44. And again, how much is left to go to the note? Notice it's a little bit more. $4 more goes to my note. And then if that's $4 more, so another 637, I take 637 off of this number, and I'm down to only owing 87.29. And then here you can see just the journal entries. And all of these numbers just simply came from my chart. My credit column, and then my 2 debit columns over here. Okay, our final item that we're going to look at here is the bonds, and this is the more in-depth part. This is the same paragraph I used in our last week's lecture, just showing the difference between what a stated rate is and a fair market value, and noting that if the bond sells for less because the stated rate is lower than the fair market, we're going to sell it for a discount. And here are the what our normal debit and credits will be when we actually issue the bonds. We're not the ones buying them anymore, we're the ones selling them. So if we're selling the bonds, what do we get? That's our debit question. We're actually getting cash. And we're going to get cash at whatever the fair market value of my bond is. And that depends on the interest rates. And then what's different from our previous week is when we credit the item, we're going to credit the entire bond value. So no matter how much I actually got, I'm going to credit what's on the face value of the bond, how much I sold. So if I only sold a $10,000 bond for $9,900, I'm still going to show a bond payable though of the full $10,000. That extra $100 is going to be called a discount. I offered it at a discount, and that discount is going to be our hidden interest, and we'll talk about that in just a minute. Okay, so let's look at this example. And I did the calculations down here in the screenshot so we can go back down and look at it. So on July 1, we were approved to issue $500,000 in bonds. However, I only issued $300,000 of those bonds. That's going to be the number I focus on. This $500,000 is extra information. Do not use it in any of your calculations. That's just how much I have. I'll have $200,000 left that I can still issue if I need to. But this is going to be our key number, what actually went out to the public. This is going to be extra information. So $300,000 bonds, $300,000 bonds that are due in 5 years, and they pay semi-annual interest. So twice a year they pay interest, and the interest stated on the bond is 6%. However, the market rate is at 8% currently. So people don't want my bond. If I'm only paying 6%, that's a lot less than the 8% they can go elsewhere. Therefore, I'm going to have to sell my bond at a discount. How much of a discount? Well, that's what I need to figure. Out of the $300,000, how much is a company willing to pay me? And then they will still get $300,000 in 5 years. So they may only pay me, say, $280,000, but I have to repay them $300,000 plus all the interest payments all along. So that's what makes my bond more attractive. Okay, so you'll see what I did here in the Excel. I open it up, click on the cell, and then hit this FX button. I search for the PV function. And then the first item, as you can walk through here, the first item is your market rate. And you want to make sure you put your market rate at, don't necessarily put it at just what it is, 8%. You need to put it at what rate it is per interest payment. So if you have 2 interest payments a year, then your market rate needs to be cut in half. If you have 4 interest payments a year, you need to divide your interest rate by 4. So that 8% would now be 2, because you're doing 2% every quarter. And then every quarter at 2% gets you back up to the 8 total. So that's what this 4% is saying. Every time there's an interest payment, and there's going to be 10 of them, because if I look back, this is a 5-year bond, semi-annual. So I'm going to have 10 interest payments. So every interest payment I'm paying 4%, or that's what the market is. However, I'm only paying $9,000 per interest. And let's see how I got that $9,000. I'm going to base it on the actual items listed on my bond sheet. The payment is, what am I going to actually give my investors? I'm going to give them interest at $300,000 because that's what I sold the bonds. That's how much bonds I sold, not $500. $300,000 at 6% times a half a year. So when you do this calculation, you do end up with $9,000 that I'm paying my bondholders every 6 months. And then the future value, the FV there, that's how much are you going to pay back total on your bonds at the end of your time, in this case 5 years. And I'm going to pay them $3 million. So after I've done this calculation, you can see this little number down here. It's $275,667.31. That's how much my investors are willing to pay for my bond. The difference between that and what I owe at the end of 5 years is my discount on my bonds. This is the amount that I call hidden interest. Eventually, this $24,000 will be slowly expensed and called interest, a little bit over the life of the bond. If I didn't do that, I would have to do all $24,000 at the end, and that would skew my financials because I would show a big lump interest that really should have been spread out over the full 5 years, just like the interest payments are. So what I'm going to do here is show you and break it down into 2 entries, what we're going to do at the end of the year to show our interest expense, and to begin what we need to do, like I said, is get rid of this dollar amount slowly and add it to our interest, our overall interest expense. So we're going to do that in 2 different entries, but then I want you to get in the habit of doing it in one joint entry, one big entry, because that's how they'll do it on the homework as well. So what I'm going to do from here on out is, after I've got the bond ready, I've already got it sent out and I've got it recorded, I'm going to begin to, every 6 months, show that I have interest being paid out, and I have a little bit more interest that's going to come out of this discount that's going to be added to my interest expense. All right, so here's the 2 that are broken out separately. The first thing is, if you note up here, I'm actually paying my bondholders on January 1. But at the end of December, I need to make that adjusting entry, and it's for the full 6 months. So I'm just going to show that instead of paying cash, I have an interest payable at the end of December because I'm going to pay them the next day. So I have an interest expense of $9,000 because that's what I'm paying, and showing that I'll pay them the money soon, in the next day. Now the homework will ask you with two different examples. Well, one of them will say use the straight line method to amortize your discount. Remember, the discount is this $24,000. How are we going to get rid of this? And there's 2 different ways. The first way that I'll show you is the straight line method. Straight line says take whatever that discount is and divide it by how many interest payments you had. It's pretty simple. So $24,000, this would be like depreciating a piece of equipment. I'm going to do it evenly, and that's what it comes out to be. Every time interest is paid, I'm going to add an additional $24.33 to my interest expense. So not only will my interest expense be $9,000, but I'm adding another $24.33 to that figure. So really, my interest expense is $11,000 plus. And then what I do is I take away however much I put on the interest. I take it away from my discount amount. So now my discount amount is, remember again, I want this number to be 0 when I get ready to sell my bond in 5 years, or redeem my bond. So I've gotten rid of now $2,000 and some of this $24,000, and I'm going to slowly get rid of the rest of it over the life of the bond. So here's what the 2 entries look like separate. But again, you're going to want to get in the habit of combining them. So I have one interest expense, the $9,000 plus the $24,000. And then I just have the two credits, just as they are, interest payable and a discount on bond payable. I'm getting rid of my discount here by $2,400. And then just to show you then, on the next day, first day of next year, I'm going to actually make my payment on my bonds. So I'm going to take it out of that payable account that shows that I owe money and actually pay it. And then come 7/1 in July of this second year, I need to do another entry that's just identical to this one, except instead of interest payable, I'm going to go ahead and just pay it on 7/1. So I'm going to go ahead and show cash there of the $9,000. And then getting rid of, again, we do the same amount every single time, $2,433. The last area of new stuff is, if we don't do the same amount every time, there is another way, and it's actually more accurate, but it's a lot harder. GAAP says you can do it this way as long as there isn't a big difference, a big material difference. So let's look at the actual way, and then we'll decide if there was a big difference or not. So when we do the effective interest, it's kind of similar, at least a somewhat similar layout to the note payables that we did above. What we actually have to do is find what's our actual interest expense based on the bond's value. The bond's value is whatever it's showing you have to pay, say $300,000, less the discount, whatever the discount value is at that time. So my bond's value is what it sold for on day one, $275,000 plus. And then we're going to compare the actual interest that we pay, the $9,000, versus what we just figured for the current, what the actual interest is market-wise. What our market interest is, and then what our actual interest is, what we pay, and do a comparison. And that's going to be the amount that we actually amortize. And so instead of up here we use $2,433, I'm going to now, for that first entry, use 2026. So let's go through how I got some of these. All right, so here's my opening numbers, how much I showed on my initial opening entry. I had $24,000 plus in the discount from bonds payable, and this was the balance now of my bond, $300,000 minus the discount. On 12/31, when the first interest in I actually compute my interest, I'm going to be paying out within the next day $9,000, but I need to calculate my actual interest. And my actual interest is you do PRT, principal. This is the principal of my bond, what the actual value is right now. And notice I did this times 4%. You could call it 8% times a half a year, and that's fine too. When I did the 4%, I just automatically cut it in my head. And when you calculate this out, you get $11,026 compared to what I did on straight line, $11,433 when I combined them. And then this 2,000 here, this is the difference. That's how I get that. The discount remaining, the amount that's still in my discount account is, well, what I started with less what I just removed. I went from 24,000 and I took away 2 more thousand, so I'm down to only a $22,000 balance in that discount on bonds payable. Therefore, my bond balance is going to go up. 300,000 minus now only 22 instead of the 24. Eventually, this bond balance will be right at its face value, 300,000, on the final day that I have to pay back my bond. So then here's my entry. Instead of interest expense of $11,433, it's now interest expense of only $11,026. So there's not a big difference. It's a little bit, $400, but the straight line would have probably been okay to use in this case. But notice here how the interest was 11,433, 11,433 the prior time. They stayed the same because we're using the straight line method. Here it's a little different. 11,026, it's going to keep going up and up. 11,107, every single interest payment, because my carrying value changes just a little bit.